Is trading gambling? Watch till the end of the video to find out more. Let's start off with casinos. How is it that they are able to make money over time in a game of chance? Okay? When traders, especially newer guys, are coming to this, they're opening up accounts. They're excited with the prospect of making money because the markets represent endless opportunities to enrich yourself. Opportunities, meaning that if you buy an asset and it appreciates in value, you can make a profit. So that's what's going on in their mind. And when they deposit their money, maybe for the first time, they may behave almost in the same way as a gambler in a casino. So if you think about it, a gambler comes to the casino. Let's talk about just an average gambler, how their psychology works. They go to the casino, they go in there with £1,000 or something like that, $1,000, and they start playing on the first machine they can see, and maybe they play the slots and they hit a jackpot, they win some money, and then you fast forward 5-6 hours, they've lost all of that money. Okay? Then they go into their bank account, they take more money, and now they go and decide to play a different game. And it's just an endless cycle, a spiral. So when these newer traders are coming into the markets, they don't have the experience of understanding their emotions to be able to make effective decisions. Now, even if they were able to restrain themselves and say that, okay, maybe I need to be a bit careful here, the things that are taking place are so strong on a chemical level that it's almost impossible for them not to fall into that trap. So they come into trading, same example, they put £1,000 or $1,000 into the account, they start trading, they may have a few wins or whatever, and then they start thinking that, they can do this easily. And in the same way, just like a gambler, they put more and more money into that thing, and pretty soon it's all gone. They take emotional trades, they fall into impulsive trading, they fall into spouts of revenge trading, and we're not going to get into too much detail on that today, but they fall into all of those kinds of things. And so they end up behaving like a gambler. Okay? So remember, trading is an unlimited arena where you can express yourself in any way that you want, as long as you're following the rules of the brokerage firm. This is a kind of freedom, ladies and gents, that you do not get in your everyday life. If you go and work a job, you've got rules. You've got to be there on time. You can't just punch out when you want to. If there's a meeting that comes up, you've got to go to that meeting. You can't just say, okay, I don't want to go to the meeting. They'll be like, okay, get out of it. We're going to do an internal review and, look at compliance and all of that kind of stuff, and you'll be out of the door. You don't have that freedom there. But when you're coming to the markets, you, as long as you've got enough money, you can take any trade that you want, as long as you've got, like I said, the money to do that. You can trade as many times as you want during the day. If it's your own money, no one is going to be tapping you on the shoulder and stopping you or pulling the plug or anything like that, unless you run out of money and the broker margin calls you, which means asking you to put more money, deposit more margin. So why is it that environment that offers unlimited potential poses such a huge problem? Because an unlimited environment combined with not having rules or structure creates an absolute albatross for all kinds of errors, all kinds of psychological and cognitive-based errors. Now, another thing that is absolutely vital to understand, why does a gambler that goes to a casino lose so much money? Well, the primary place that you have to look at is the frequency of how often they are playing these games. They may go into the casino with thousands and thousands of pounds or dollars, depending on where they are in the world, and they start wagering on different games. And there's no end. So in a time span of 12 hours, they could have played 2,000 games. Think about that. There's no restraint. There's no control. And the casinos, they invite that kind of behavior because it's more money for them. They're not going to say, oh, you need to stop playing here because you're losing too much money. No, they want the players to continue playing, so they end up with all the money. It's a profitable business for them. But the problem with these gambling games, for people who get into that kind of a thing, is that they become addicted to it. Every time they play a game, they are anticipating the chance that they could win. And in the brain, that creates a dopamine-dependent addiction over time. They literally become addicted. They literally become addicted. Their heart rate is jacked. They're rocking back and forth in their chair, and when they're placing their bets, did I win? Oh, it's like a life or death situation for them. Now, how is it when it comes to trading? Trading is just another environment. It's another environment. It's like a big casino. But the difference between trading and playing in a casino is that the trader can choose his own rules for the game. Does that make sense? When in the casino, the games are fixed. What I mean by that is that there are rules, and they are designed at the start, before the player even starts. So if they're playing a game of roulette, there's 18 red numbers, 18 black numbers, and 2 green numbers. So when the player bets, he thinks he's going to have a 50-50 chance of winning that game if he bets on red. It's not true, because there are 18 red numbers, 18 green numbers, and 2 green numbers. Now on a 1 or 2 or 3 bets, it's not really significant, but over thousands and thousands of bets, the house edge plays out. And that's how they end up with all of the money at the end of the day. They have a statistical edge over the player on every single round of that game. Yeah? On every single round of that game. Now, when traders are coming to the markets, they are in many ways, I'm talking about the inexperienced traders and even, intermediate guys and girls that come to the market, they are bringing that same kind of mentality and psychology with them. And the biggest issue is that they ultimately end up getting addicted to the act of trading, to the act of placing the trade. It's not so much about the money, it is about the neurobiological link between the act of pressing that button, taking a trade, and what could happen. Is it a win? Is it a loss? That is where the addiction starts. So again, for brokers, clients that come in and they're doing a lot of that and they're taking excessive positions and they're falling into these impulsive places of trading and they're taking revenge trades and stuff like that, the broker's just going to make the money and they're going to get commission for every trade that the trader closes. So if you understand how the problem starts, you understand the picture better. It's the addiction that is the problem. Now, I pose this question, and I've thought about this from a logical standpoint, that what would happen if that person going to the casino would just control and do what they need to do in the sense that they don't play hundreds or thousands of games? What would then happen? Well, as I said, the casino's games are built in a way that the casino has the house edge. You've heard that saying, the house always wins. Play long enough, the house always wins. The house has the edge. Okay? That is why playing any kind of gambling or casino-based game, it doesn't make sense. It just doesn't make sense. Because the odds are against you. And the stupidest thing that I've seen that many do is they play these slot machines where the probability is just minuscule and they just keep pressing those buttons and letting it go. Anyway, back to our topic on trading. It starts with awareness. It starts with understanding that it is designed in a way to trap a lot of new traders to come in, deposit money, and just keep trading and trading and trading and trading and trading, creating addiction. There's been examples of many people who have got addicted and lost accounts. I'm not going to name names. And it's just become an absolute albatross of errors and drains financially. Okay? Now, the difference with trading as well is that the trader can choose their own edge. Okay? So a trader can risk 1 for 1, meaning for every £1 pound or dollar of risk, they stand to make £1 in profit. £1 or $1 in profit. So it's a 1-to-1 risk to reward ratio. Okay? But if a trader uses something like a 2-to-1 ratio, then what it means is that on every winning position, they will cover 2 losses. So with a system that has a one-to-one risk-to-reward ratio, I think a trader, don't quote me on this, I need to check my facts, needs to win about 66% of their trades to make a profit. I think it was something like that. Whereas on a 2-to-1 ratio, a trader is break-even at a 33% win rate, meaning if they win 33% of their trades, they're breaking even. Anything more than that, they're making profit. So there's this idea in the industry that, oh, you know, people are attracted to these insanely high win rates of 70 to 80% or 90%. But the reality is that professionals make money with very low win rates. You don't need 70, 80, 90% win rate to make money in trading. Traders can make money with just 35, 40, 45% win rate. And in fact, the most profitable traders in the world, they're winning about 40 to 50% of their trades. Yeah. So the majority of the trades are losses, and the minority of the trades that are winners outweigh the losses. So you take an example. If you have 10 trades, and from those 10 trades you win 3 and you lose 7, then what ends up happening is you'll pretty much break even, maybe a bit of a loss, okay? But you don't lose your arm in the process. If you win 4 of those 10 trades, you're in profit. If you win 5 of those trades, you're making a very good profit. And if you're winning 6 out of those 10 trades at a 2-to-1 ratio, you're at the golden ratio. And that's what most professionals try to achieve. A 60% win rate, winning twice as much on their winners than when they lose. Okay? So that's the difference there. That's the difference there. Now, when it comes to real trading, the problem is that most are inexperienced to the level that they need to be able to follow their plan. So they will adjust their stop loss, they will adjust their take profit target. So take profit target is a level that you decide to sell the position if it goes in your favor. And you lock profit and you close the trade. Okay? And because of emotions like fear or greed, they will hold on to trades longer. Okay? There was actually a study done for this that across a sample of thousands and thousands or millions of accounts, what they saw was that clients would tend to hold losing positions longer in the hope that it would come back, and they would cut winners earlier out of a fear of losing profits. And therein lies the problem. They are doing exactly the opposite of what they need to do. Okay? It's counterintuitive. And so because of these emotions and natural inclination to losses, so loss aversion, even if they have a 2-to-1 system, they can't make money on that. Okay? And there's so much more. There's so much more than that. And we're just getting started. So if you enjoyed today's video, give it a thumbs up and subscribe for more content. All the best and stay safe.